So why is cash flow important? Cash flow is the lifeblood of all organizations. Your organization just can't exist without a healthy cash flow. Cash flow is a cycle. It's a cycle of inflows, it's a cycle of outflows. If you don't keep these in balance, even profitable organizations can go out of business. So now more than ever, it's vital to know what your cash balance is and know what you're expecting it to be in the future. You see, cash reserves are important. When we have a healthy cash reserve, it provides us in time or a buffer in times of crisis, especially when we feel the impact of decreased sales or customers having difficulty keeping up with their payments. There's also significant benefits of a well-managed cash flow. When you manage your cash flow well, it gives you access to better credit. And a well-managed cash flow really is a significant factor in increasing the value of your business. There's three types of cash flow activity. When you understand each one, you can make them work for you. You'll see on our chart in the first column the three types of cash flows: operating cash flow, investing cash flow, and financing cash flow. Operating cash flow is the cash that comes in from your day-to-day operating activity. This would be your regular sales, goods or services, making inventory purchases, or just paying your regular overheads. Investment cash flow is distinctly different cash flow. When we think of investing activities, we often think of buying stocks or bonds. But when we talk about investing cash flow, we look at assets that we're buying as an investment in the organization. So these would include things like buildings or machinery and equipment. Financing cash flow is the third type of cash flow. Now, we often see financing cash inflows, say from a bank loan, maybe a loan coming in from the owner, or a shareholder buying new shares and injecting new cash. We can also see financing outflows. So that would be typically paying your loan or paying out a dividend. The point is, it is really important to understand the nature of each of these cash flows. If you're in the habit of looking at your income statement as the sole source or measure of cash flow, and many of us do, but you can miss the impact of investment cash flow or financing cash flows. In fact, depending on the business, you can run out of cash while still showing good profit on your income statement. But by watching each cash flow, you can avoid this trap. So let's take a look at the conversion cycle. We'll follow a 70-day cycle of a typical manufacturer. Now, if you are in a business or a not-for-profit organization or service business, it's the same concepts apply. It's just you're not doing quite as much. But in the simplified model that we have here, we'll take a look on day one. We purchase raw materials. Now, during the month, by day 30, we've turned the raw materials into a finished inventory of, we'll call them widgets. Now, day 35 comes along. We have our first cash outflow when we pay the business that supplied us with the original raw materials. On day 45, we sell all the widgets. we invoice the customer. Now, at this point, we still don't have our cash. Our customers have 30 days to pay their account, so on day 70, we receive payment. Now you'll note our cash goes out on day 35, and then it comes in on day 70. The time between day 35 and day 70 is our financing gap. And in this case here, the gap is 35 days. So the 35-day financing gap represents the first part in calculating the working capital that we're going to need. This slide shows us a really simplified pictorial model of the working capital financing gap. If you take a look, you see our cash going out when we pay for the inventory. Cash is coming in when we're paid by our customer. Now, I put this in a graphical form. How do we calculate cash that we need to fill the financing gap? So remember, in our example, our financing gap is 35 days. Now, there's a mathematical equation that we can use to calculate how much cash we need to bridge the financing gap. You'll see that in red at the top of the page. Now, our chart is based on $1 million in sales. And if you take a careful look at the chart, on the vertical axis on the left, we have the dollar value of working capital required. You see that goes from 0 right up to $350,000. Now on the horizontal axis, on the bottom, we have the financing gap by number of days. So by triangulating with annual sales of $1 million, a financing gap of 35 days, we're going to require capital of $100,000. Now take a look as we close that gap. We go to 20 days, we're going to require $50,000. If the gap moves out up to 60 days, you require financing of $165,000. There's one thing about COVID though, slower paying has become a reality. And in fact, 90 days is the new 60 days. So if we move up the graph and take a look at 90 days, we're going to need as much as $250,000 in working capital. So by looking at the chart, you can see these small changes that we make, you can really influence the gap and have a significant impact on the financing that you're going to require. You can have an impact on the financing you need when you know what tools to use to close that gap.